Hello and welcome to the TechGig podcast, folks. I am your host, Sukriti. Thank you so much for tuning in. Today's episode is about how technology is empowering investments. The impact of disruptive technology on capital markets is as significant as fire was to the cavemen. It is the time that leaders in the industry embrace new age technologies, which are further going to transform the capital markets ecosystem in the coming years. Technologies like machine learning and artificial intelligence are part of the financial institutions, among other aspects like investing trading. And the technology here is not a replacement for the human brain, but is a tool that is going to make it even smarter. And to further deep dive into this conversation, I am here with the co-founders of Upside AI, a homegrown machine learning-based investment management platform. Folks, please join me in welcoming Kanika Agarrwal and Atanuu Agarrwal, the co-founders of Upside AI. Welcome to the show, Kanika and Atanuu. I'm so excited to have both of you here with me today.
Hi, Sukriti. Very excited to be here. Thank you for having us.
Hey, thanks, Sukriti. Really excited to be here as well.
All right, so let's get going. And I am so eager to know the details of how technology is aiding this entire investment platform for the market. So let's begin with you, Adanu. Tell us about the investment market and how the dynamic is right now, and how do you see the inflation factoring the market at this point in time?
Yeah, I mean, I want to preface this by saying that the market at any point in time is an extremely complex system, right? Despite what you might read in newspapers and see on TV channels, it's not as obvious as one would think. It's not a linear equation that you can input the data and know the answer, right? It's a system of several moving parts where each of those parts affect each other and also then affect the market. So at any point in time, I think it's very hard to know which way the market will go. I think it's almost impossible to predict short-term market movements. I think you can try and deduce some long-term trends, but it's very, very, very hard to make reliable predictions in the short term. And that is true for inflation as well, right? I mean, we all know that generally, both locally and globally, we've been experiencing inflation for various reasons. A lot of it is due to supply chain issues and supply side issues due to the Russia-Ukraine war as well. But over the last few months, what's happened is inflation has been coming down, right? We've seen a pullback in oil prices. We've seen a pullback in commodity prices, and that's been one of the reasons why the markets sort of bounced back. The equity markets bounced back in July, and again, I don't want to venture a guess as to what will happen in the next few months, but all I can say is that generally the markets like benign inflation, a little bit of inflation. They definitely don't like no inflation. So the markets want some inflation, but they are allergic to very high inflation that we've seen in the last year or so. But looks like things are improving, from what we can see right now around the globe.
All right. So, Kanika, coming to you, how do you see the human intervention here when it comes to decision making or any other factor right now?
Generally, there are a few ways to answer this question, right? One is what happens in different markets, what happens over the long term, and how humans react. So let's use the US as an example of a very mature market, right? And see how human decision making has played out there in the markets. There, what you're seeing is that all investor money, whether it's retail or high net worth individuals, is moving away from human experts into some version of systems and rules, right? Look, let's look at mutual fund money. There is now more money managed by ETFs and index funds in the US than by actual human fund managers and mutual funds. This is true of hedge funds as well. So essentially what that commentary is on is that there is less trust in human decision making than there is in a system making the decisions for them. Here in India, we're still largely using systems to run trading activity, but most investing decisions are still made by humans. That will also shift as our markets mature. The second sort of vector to answer this question really on is how good are they at figuring out what's going to happen? You just asked Atanuu a question about inflation, right? And he dodged it very well. And the reason is he gave you himself is market is a complex system. You can't possibly figure out what's going to happen. It's not linear. So most people who come on, shows will tell you, okay, market has already gone up because inflation has gone down. No one is coming on and saying, okay, here's what I think will happen over the next 6 months, and doing that consistently with great predictability, right? Experts have about a 50% hit rate as far as getting the predictions right go. So as far as decision making of what will happen, I would say humans are average. To explain what just happened, they do a pretty good job.
That was fantastically put up, Kanika. That moving to you, where does technology stands to help reduce human error?
Right, it's an interesting question. I think there are basically two pillars or sort of two vectors on which technology can help human beings, right, as a tool. And I think the two vectors are, one is of course the more obvious one, where computers now can parse or assimilate much more data than human beings can, right? They can, even the smartest human being, an average computer can easily supersede the smartest human being on the planet, right? And can sort of absorb vast amounts of data and sort of draw inferences from it, and sort of be able to give you insights that you may not be able to get using even an army of human beings. So that's obviously one vector on which technology can help you. And as I said early on, that markets are a very complex system with lots of moving parts. So you need at times to absorb lots of data and need that edge to be able to try and do well in the market. So that's one vector. The second vector is, I think, more sort of less obvious and sort of more soft in a way, in the sense that I think enough studies have shown over time that that human beings tend to be bad investors, right? And the reason for that is that we have a certain genetic code that's hardwired in, which makes us prone to emotional biases that are very well documented, right? For example, if you read Thinking Fast and Slow, which is an excellent book by Daniel Kahneman, he's a Nobel Prize winning economist, you'll see that he talks about biases like herd mentality and loss aversion, and then FOMO, as some of us have seen in the crypto craze recently. So we are subject to all of these biases that end up sort of hurting our portfolio returns and make us bad investors, right? But the advantage of relying on system or relying on technology is that it helps you beat those biases, because the machine has no inbuilt biases as such. The machine doesn't care how it did in the most recent past. It can be more ruthless and more objective in decision making, right? So I would say broadly there are two vectors. One is the ability and the capability to absorb vast amounts of data and create useful insights, and the second is sort of protect us from ourselves, right? And be able to and help us overcome our own emotional biases and make more rational decisions more consistently.
Okay. Kanika, coming back to you, how does AI stand out in investing? When I was talking about setting up our conversation and what I'm going to get the details of from both of you, AI and machine learning have been an integral part of the investment platform these days. So help us understand, how does it stand out when it comes to investment particularly?
Right. So that's actually an extension of Atanu's answer, right? Where he was talking about, one is using technology. So technology puts some rules, some method to the madness, if you will. AI, machine learning, the reason even we use it or anyone else uses it is that you are able to make dynamic rules, right? So there are three pillars on which any good investing should work on, whether human or machine. One is you use more rules than emotions. Two is you try and use more fundamental data to make investing decisions. And third, most importantly, is make sure that your rules are dynamic, where they change with the markets. You're able to learn market conditions, learn what's happening, and then accordingly adapt to it. And that's really where AI comes in, which is, are you able to constantly change what your rules look like? So, let's take an example, for example, P, right, as a ratio, very well used world over to analyze and evaluate valuations. What does 20 PE mean? It means very different things in different markets. In a different interest rate environment where, say, interest rates are 10%, 20p doesn't mean anything. But in a zero interest rate environment, 20p is extremely expensive. So depending on where you're standing, your perspective has to change. And that's really what AI is doing. It's just standing at the current moment in time to make a decision. Human beings usually, like Atanuu was saying, hardwired and therefore come with a certain context, right? They hate some industries, they love some stocks, they find it tough to book their losses. None of that applies to using artificial intelligence. It has no ego. It's just standing today trying to make the most optimal decision it can. Doesn't mean it's always right. It's just able to play, slightly higher or better odds for itself. And that's really where AI comes in, into investment decision making for us and for anyone else who's using it.
Thanks, Kanika, for that. I'll go back to Atanuu. Ask, about, of course, since we're talking about technology. Atanuu, how does Upside AI work? So yours is also a machine learning aided platform. How does it actually work? And tell us about the functionalities out there.
Right. So Upside AI is essentially an asset management firm, right? Which means that we manufacture products, we create sort of funds where we invest in equity, debt, gold, and we have different products for different risk appetites, right? And we cater to a large sort of customers, including large family offices and institutional clients and HNIs, right? So that's sort of at a high level what we do. We are essentially a fund asset management shop, and we create products with different risk return profiles. How we go about doing it is that, I would say that Upside, where we, as you may have deduced by now, that we are very technology forward. We are totally systems based, rules based, right? So all our products, the fund manager is not Kanika or me or Nikhil, our third co-founder. It's actually an algorithm that we've written, which runs the products, right? So all our products are run by technology. We believe that that's our best chance of winning for our customers. So that's one pillar. And the second pillar is that we are, unlike other shops that tend to use technology, they tend to be a lot more on the trading or technical side. We are much more focused on fundamentals, right? And when I mean fundamentals, I mean two types of fundamentals. One is what I call macro fundamentals, which is stuff like GDP, inflation, real yields, stuff like that, right? So fundamentals of the economy and company fundamentals, right? And company fundamentals are stuff like the balance sheet, the cash flow, P&L, how the business is performing, right? And what it is, how the business is performing relative to the price at which the company is available. So stuff like that. So we don't use technicals at all. We are a pure fundamental shop, and the way sort of we leverage this data is that we feed all of this data into some proprietary algorithms that we've built, and we rely on, as Kanika said, machine learning tools to be able to parse this data and tell us that what is the most optimum portfolio to be invested in prevailing market conditions, right? So what the edge that gives us is that we are able to adapt quickly to different market conditions and build a portfolio that has the highest probability of winning in that particular market condition, right? So we are dynamic in that way. We are not a static shop. So I would say that we combine the best of both worlds, where we are fundamentals based, right? Which sort of is where most of the money is managed around the world. But often fundamentals based managers tend to be static, right? They tend to do well in certain periods and then they don't do well in other periods. So that we address by being dynamic, right? So we are hoping to be much more consistent across market cycles.
Wonderful. Okay, so Kanika, we've spoken about the market dynamics. We have spoken about the technologies, that's aiding the entire investment platform, and how the perspective, the approach that is being looked at with the newest technologies altogether. Let's talk about the future. What do you think? How does the future, look like? What are the plans of your funding, especially in the coming years?
Sure. So for us, we're here for the next many decades, building out what we think we will. Essentially, our vision over the long term is to be a tech-first asset management company, where you are using technology to build the right products for investors. You're using technology to solve processes across the board. So it should be an entire supply chain built fully in technology, from the beginning to the end. And you want to use that to democratize investing, where not just high net worth individuals have access to sophisticated products, but it should be available to everybody. Even if you have 1,000 rupees, it doesn't mean you should not have access to best in class technology to help you make investing decisions. So that is really long-term vision for us, to be in every Indian's equity, and actually every Indian's investing portfolio should have Upside AI in it. As far as funding goes, we raised a round last year. It was a seed round, where we were profitable when we raised the money. We were bootstrapped till then. Are not actively raising funds. Don't really need them. Our business model is reasonably solved. At any point, if we decide to raise money, it will be to either propel us to the next stage, or to figure out where the next stage of growth comes from. So no real plans as of now.
Thank you so much, Kanika. Thanks, Atanu. I think I had a great time with this conversation. And thank you so much for bearing all of us about how technologies like artificial intelligence and machine learning are enabling the investment platforms with the dynamic market mediums right now.
Thank you so much, Sukriti, for having us. Really enjoyed this chat. I'm hoping your listeners take away a few things from what we discussed. One is, technology is here to stay. Two is, it's very important to add to your portfolio. And three is, for all human beings, even if you're making decisions yourself, try and add more rules to your process, and move away from emotions and biases.
So, audience, it's a wrap. Thank you so much for tuning in and listening to us. Stay tuned to TechGig for all the latest tech updates and happenings. This is your host signing off. Thank you so much.